Hi friends, in this session we will talk about reading number 18 of book number 3, Financial Markets and Products, Mortgages and Mortgage-Backed Securities. This reading is very important for your exam. You will get approximately 2 to 3 questions from this section, but the questions are very standardized, okay, based on the past analysis. And this reading is easy if you know certain concepts. So what we will do here, we have some basic discussions. So instead of reading each and every line from this book, I will give you the quick overview of easy concepts, and then there are some difficult concepts. We will discuss these concepts which are difficult to understand by self in detail, right? So first we will start with the basic understanding, and we are going to use the Falcon notes for this reading. So first we will start with the basic understanding of the MBS, mortgage-backed securities, and the mortgages. MBS is the special category of asset-backed securities, ABS. Okay, this is a special case of ABS. So before we begin the discussion of ABS and MBS, first let's understand the traditional model of the banking, which we already discussed in the reading number 1, how the traditional model works. And then we will extend this traditional model into the advanced model, or the new or the recent model, which is the securitization model. First, just see the example of traditional model. So this is your bank, and here you have some depositors. Okay, so depositors, and these are the borrowers. So what is the traditional model of banking? Depositors deposit funds in the bank, and bank use same funds to provide loans to these borrowers. Just say borrower A, B, and C, and then depositors are there. So just for now, like assume bank is paying 7% on these deposits, certificate of deposits, or if you're from the India, then the fixed deposit, you can take the fixed deposit as an example. And bank is charging 10% from the borrowers. Okay, so just assume $1 lakh loan provided to A, and again, for example, $1 lakh deposit is received from this depositor. So in this case, what happens? So bank collects 10% from the borrower, keeps 3% and pays 7% to the depositor, and 3%, this 3% is for the operational cost of bank. And also this compensates for the defaults in the borrowers, from the side of borrowers. It accounts for the defaults, and then we also have profit for the bank. Okay, so this is the composition of this 3%. We will discuss more on this default part in FRM Part 2. One more information about this chapter is, here we have to limit some discussion, because that discussion requires some prior understanding of some concepts, underlying concepts, which are not discussed in the FRM Part 1. You have these concepts in the FRM Part 2. And you have topics, or at least like 4 or 5 topics on the mortgage-backed securities or similar topics, which is the asset-backed securities, at least like 4 or 5 topics in the FRM Part 2. So even if we cut short the discussion in some areas, you're not going to lose on the knowledge first, because you have like complete area of MBS, all the asset-backed securities, CDOs, CMOs, and everything in FRM Part 2. Okay, so you don't have to worry or bother about it. Here we will focus on the exam important points. So this is about the traditional model. We will discuss default part. One small section is in the FRM Part 1 itself, in the credit risk chapter. And then in detail, we will discuss everything from the probability of default model to everything like credit scoring model and so on in FRM Part 2 credit risk chapter or credit risk book. And then profit is profit, and operational cost is, again, we don't have to discuss these topics here. Okay, it's not a part of our curriculum. Right. So this is the bank charging or keeping 3% as a commission, operational cost, profit, and everything. Charging 10% to borrowers, paying 7% to depositors. Now see what happens. When depositors deposit these funds, say in each depositor here deposited 1 lakh in bank. Now bank have only 3 lakhs to distribute as a loan. And again, we will assume, so this is say 50,000 and this loan is for say 1,50,000. Okay. So this is a traditional model. Now in this securitization process, what bank does is bank transfers these loans in a common pool of assets, which is currently we have $3 lakh worth of assets. So bank will transfer these loans. Loans are asset for bank. When bank provide loans, that particular loan is receivable for bank. So bank is going to receive the principal and the interest back. So this receivable is asset. This receivable is always asset. If you're from the accounting background, it is easy for you to understand. You already know the receivables are the asset. If you're not from the accounting background, so just for the example, say you gave me $1 lakh and now you want to, like, you will get it back after some time. So this is receivable for you, right? So receivable is your asset. What bank will do is bank will create a common pool and bank will transfer all the receivables in this pool. And then there are investors. For now, let's assume only one investor, Mr. I. Now investor will invest in this pool at say 10%, right? So this investor will pay 3 lakh and he will receive securities against it. Okay, and we will take securities like this. Securities worth 3 lakhs, 3 lakh face value at some price, and then bank will pay some funds or some portion of this income to this investor. So let's assume 9% or 8%. Okay. So these securities have coupon rate is equal to 8%. So now see what happens. Once this investor purchases the securities, this pool have 3 lakhs in cash. This 3 lakh will go to this particular bank. And now bank have $3 lakh again to provide as a loan. Now imagine there is borrower D who wants 3 lakhs loan. Now he can get the loan from bank, right? So at the rate of say again 10%. Now again bank have 3 lakh rupees receivable because again bank provided loan of 3 lakh, right? 3 lakhs loan to D. And again bank can create a second pool, next pool, and again some investor will invest in it and again he will receive interest for that. Now this is the interest transfer. So what's happening here is whatever is bank receiving from the borrowers as an interest and the principal, bank will return this particular income to I after keeping certain commission, that is say 1% in this case. And this 1% will act as an income for the bank and bank can keep running this business. So every time bank have receivables, bank will transfer to the pool will, like, there will be investor who will invest in the pool, bank will receive the cash. Now bank have next available cash which bank can lend to other borrowers, right? So this is how the securitization works. Securitization. Now what is the concept of securitization? Conversion of these assets or the receivables into the securities. See, investor is invested in the securities. So conversion of receivables into securities is the securitization process. To make sure the investor is safe, even if the bank defaults, for this purpose, this pool is kept as a separate structure or the separate entity called as a special purpose vehicle. Now, this special purpose vehicle is a separate entity. It is not linked with the bank. In case bank defaults, SPV is not going to face any problem because it's an independent entity. If SPV fails, then bank is not going to face the problem. Okay, so this is the separation structure. If bank plays some tricks and transfers asset in a very nominal way, this is not an actual transfer and just a nominal transfer, on paper transfer, there is a risk for the bank. Why? Because judges, if this goes into the court, this matter goes into the court, then judges will merge these entities and say, no, these are not the actual transfer. This is the one and the same entity. And again, if one bank defaults, both the entities will default, or one of the entity, if one of these entities default, then both will default, right? So this is the securitization basic structure. And now here, assume that A, B, C, D, first A had car loan, second B had like say home loan, and then credit card loan here. It's too much, like 1,50,000 for the credit card loan, and let's say this D is say for the business loan. Okay, now we have variety of loans, and bank is creating a pool from variety of different types of receivables where the collateral is very different, right? If this is the case, then this becomes a asset-backed securities, very general category of the MBS. Okay, so asset-backed securities, because this pool, these securities in which the investor is investing are backed by the asset. That's why asset-backed securities, right? Now we have MBS. Again, same case, A, B, C. This is the bank. Bank is transferring into their assets into the pool, and then there is an investor, and we will take the same example. Investor is investing 3 lakhs, pool is of 3 lakhs, and then this is the bank. Bank is providing loans, sorry, here ABC, and let's take 1 lakh each. Okay, so 1 lakh loan for the each borrower. If these loans are for the home loans, so obviously bank will transfer these receivables in this pool, and these all the assets linked in this pool are of the home loans, right? So this particular category is called as the mortgage-backed securities, MBS, mortgage-backed securities. Now, what is a mortgage? Mortgage is a loan provided for the home or the house or for the real estate, where that real estate property is kept as a collateral by the bank, and that collateral is called as a mortgage. Okay, so this complete structure of bank providing the loan and then bank keeping that particular real estate as a collateral, this particular structure is mortgage. And then mortgage-backed securities. So here our assets are mortgages, so that's why mortgage-backed securities. This is very easy to understand. Mortgages, mortgage-backed securities, right? This particular structure faces two types of problems. So first problem is default by borrower. Okay, default by borrower. If the borrower defaults, now investor have receivables, right? So bank is not going to face the problem, investor will face the problem. So that's the first problem for the investor. Right now this is not for the bank. Why? Because anyway bank is keeping just 1% of this 10% transfer, and all the rights of this receivable from the borrower are transferred to the investor at 9%, right? So this investor will face the problem. Second problem is prepayment. What is a prepayment? Some borrowers prepay early or repay their loans early according to the schedule, as per the schedule. Okay, so not as per the schedule, not according to the schedule, right? So as per schedule, say you're supposed to pay your loans in say 5 years and you paid it in say 2 years only. So that's a prepayment. And investor faces this risk again, the prepayment risk. Why? Because investor is expecting that he will receive 9% on like say annual basis, right? And obviously this will be monthly. He will receive this interest plus principal on the monthly basis, that is 9% divided by 12, whatever is the percentage rate. But if he receives these funds early, then he will lose interest on it, right? So if he loses the interest on it, then this is the loss for him. So if he suddenly receives $1 lakh from say C, instead of getting it across like along the 5 years and then receiving interest on it on those 1 lakhs. So he will lose his money because he's not going to receive any interest on it. Then he has to reinvest this 1 lakh in some different security, and then there is a problem. He might not get the 9%. He has to settle for the 6% or 7% like that. Okay. So that's the MBS, ABS, securitization structure in general and everything. We will discuss securitization in detail in FRM Part 2. For FRM Part 1, this general information about the securitization is more than enough. So this topic starts with the introduction of mortgage. What is a mortgage? Then there are 2 types of mortgages. So first is the fixed rate mortgage where interest rate is fixed at the time of providing the loan. Bank will say, okay, you will be charged 10% interest rate, and that 10% interest rate is same for the life of the particular mortgage. Okay, this is a fixed rate interest rate or the fixed rate mortgage. Then variable or the adjustable rate mortgage. So variable rate is generally it fluctuates with the market rate. 1. Then there is adjustable rate mortgage. It is not going to fluctuate every time the market rate fluctuates, but it will fluctuate if the certain criteria is breached. If the market interest rate say goes up by 2%, then maybe that increase or decrease in the interest rate will trigger. If market rate falls by 2%, then it will trigger. I'm just giving the generalized example and not the specific example here. So variable rate and adjustable mortgage rate can or may change in the life of the mortgage. Fixed rate will be fixed, adjustable will change. Then we have the discussion of the mortgage-backed securities, which I already explained in this particular setup. So again, in FRM Part 1, we discussed like originate to distribute model. Okay, so whatever we discussed here was the originate to distribute, and bank is the originator who will originate the loans, and then bank will distribute these receivables to the pool, and then pool will provide the securities. So this is the originate to distribute model. So this question might come in your mind, like why investors are not directly providing the loans to these borrowers instead of providing or buying the securities in the that particular pool. If he's at the end, he's going to receive that particular interest plus principal back as an income, and with this there is also like he's losing 1%, right? So the problem is bank have expertise in providing loans, finding the worthy individuals to whom the loan should be provided. Investors are not expert in this, right? Then second question is like why bank is not taking more deposits to provide further loans. So the problem is accepting deposit or taking deposits is not very easy thing. Okay, so even if it is cheap, it is not very easy. So that's this problem for the bank, and the investor solve problem for each other, right? So here we have MBS is a special form of securities, like the asset or special form of asset-backed securities. It creates a special pool, and special pool is created by the special purpose vehicle, separate entity, and bank first will transfer all the receivables to that separate entity, SPV. Okay, and then SPV will do all the securitization process, and then it will provide the securities, take the money, transfer it to the bank, and there will be like other agencies who will help bank, SPV, and the investor to make sure everything works in the orderly manner, right? Now next is the loan amortization schedule. Loan amortization schedule is important for further discussion, the next discussion which we have here in this chapter. But you need to like understand the how the amortization schedule works. So here we are taking the example. Okay, and what is the amortization schedule? So when, just imagine yourself, when you take any loan or borrow some funds, and when you repay it in the monthly installments or say annual installment, but we have mortgages. In mortgages there is monthly installment. If you have monthly installments or you have to pay monthly EMIs, in that particular case, whatever you are paying, there are 2 portions of it. So say you are paying 10,000 as EMI. So there are 2 portions. First portion goes for the principal, second portion goes for the interest rate, and that interest or the principal is slightly gets adjusted for your payments, and it will goes to 0. How it works, I will show you the table here. We have complete schedule, amortization schedule. Okay. So first of all, we'll start with the illustration. So we are keeping things simple here. So we are going to assume only 1 year fully amortized. Fully amortized means by the end of the, like by the last EMI, your complete loan will be null. Okay. So 1 year fully amortized, $1 lakh mortgage loan, and fixed rate of 12%, compounded monthly. So this is the monthly compounding, meaning you can directly divide it by 12 and you will get the monthly interest rate. Fine. And to calculate the monthly payment, we can take the help of TBA To plus calculator. Okay, so what you have to do here is you have 1 year and 12 months. So total N is equal to 12. N is equal to 12. I by Y, yield or the interest rate here is 12%. Again, it is monthly compounded. So divide by 12. If in exam you're not provided with it is a monthly compounded or continuously compounded and so on, so assume monthly compounding instead of assuming any other thing. If you assume annual or effective annual or continuously compounded, it will complicate your discussion. So just stick to monthly compounding. GAF will provide you the information about this, the type of compounding. Unless otherwise specified, assume monthly compounding. Very simple. So 12% is the rate, 12% divided by 12, 12 months are here. So you get 1%. So I by Y is equal to 1%, right? Then you have PV, present value, cash outflow. So cash outflow is you are paying 1 lakh, bank is paying 1 lakh. Okay. So that's why cash outflow, you can keep positive sign or negative sign. That's not going to create any problem for you. FV, future value, that is at the end of this loan term, the value in that account should be 0, right? So principal should be 0. So F is equal to 0. CPT PMT, and this will give you monthly payment, and monthly payment is 8884.87, that is 8,885 approximate. Now let's see how this schedule works. So this is your beginning balance, which is $1 lakh, and this is the EMI, right? So 8,884.88. Okay. So first, this gets adjusted for the interest. And how? So bank provided you $1 lakh worth loan. On this 1 lakh, 1% interest. Take your calculator. You don't need calculator to do this calculation. Okay. So bank will charge 1 month's interest rate because see, you borrowed 1 lakh first, obviously for the full year, but by the end of 1 month, it is for 1 month only. So bank will charge 1 month worth interest rate. So here, first we will adjust 1,000, which is 1 month's interest in here. The remaining portion of this your EMI, this is your EMI. Remaining portion of this EMI is adjusted for the principal, which is 7,884.88, whatever. And this will get adjusted in principal. That is, you repaid some principal and you also paid the interest. So 1,000 in interest, you repaid your principal 7,884. Remaining balance in this particular account, the loan account, is 92,115, right? For next part, again, this is the beginning balance. You paid the same EMI. Now again, 1% of this goes into the interest payment. Again, you have 92,000 loan for 1 month, right? And remaining portion will be adjusted for this particular loan account. Okay, and this will keep happening. You can see as the principal value or the loan value decreases, your interest payment will keep on decreasing, right? And principal will keep on increasing. Why? Because at the end, principal payment is the difference between the EMI and the interest rate. If the interest rate is going down, automatically your principal payment will increase. And you can see automatically you will have 0 remaining, ending balance is 0 here. Okay, so last EMI will settle everything. So see here, this is your principal balance remaining. This is what you paid. This was the interest you paid, and this portion is for the principal matched, and this is 0. Okay. So this is a loan amortization table. So what do we need to understand here or remember here? Okay. So for exam purpose, always remember, interest is high in the beginning. It keeps on decreasing. Principal payment is low in the beginning, keeps on increasing. Loan balance is high in the beginning, it keeps decreasing and reaches to 0. As simple as that, very simple, right? Again, this is the chart for your understanding. Loan balance is decreasing, and then you have principal payment is increasing like this. So your graph exactly will not look like this. So ideally the graph should look like, I'll just show you. So this is the interest payment, this is how the interest payment goes, and this is how the principal payment goes, okay, and like this. So low in the beginning, high in the end, and interest high in the beginning, low in the end. Interest and principal payment, right? So this was the loan amortization table. Now, factors which affect the prepayment. Here we are discussing the prepayment, the first type of risk bank faces. So prepayment is like, there are reasons for the prepayment. So borrower might prepay the loan because property is sold. Some borrowers will sell their property, right? So house, and whatever they collect, they will first pay the loan, and whatever is the remaining, they'll get it. General scenario, if you are from the India, it is very difficult to imagine someone is selling their home or residential like house and everything, like for any purpose. Okay, it is very rare in India. In general, like in other countries, generally, if say this happens, so say you bought loan, or you bought the house which the current value is 1 lakh, and just imagine you took the loan of 1 lakh. This is the price of the house or value of house. Okay. Now say there are certain scenarios or some happened in that area, and now the price of this house is $60,000. So the, like for borrower, the homeowner, the problem is like the current value of that particular house is 60,000 and loan is 1 lakh. So it is not worth for him to pay this 1 lakh for the 60,000 house, right? So generally he will default. Second scenario, if the price increases to say 1,20,000, just say in the next month, then it is better for him if he sells the house. He will be able to encash 20,000 in profit, and remaining 1 lakh can be settled against the loan. So 20,000 profit for no investment, right? So these are the reasons why the homeowner might default or prepay the loan. Okay. And next is refinance at the lower rate. Currently, say you bought a house and that was at the rate of 9%, and current market rate is say 7%. So it is better for you to like refinance it, take new loan at 7%, repay your existing loan which is at the 9%, and then for the rest of the mortgage life you have like decent 7% interest rate, right? So this is the second reason. So first reason is reselling of the house or selling of the house, not reselling, and then refinancing. Okay, sell and refinance. This creates a risk for the lender because loss of interest is the first reason, as we discussed, that lender, as in the bank, will lose the interest, and if this is the securitized structure, then the investor will lose the interest. And then second is the reinvestment risk. What is the reinvestment risk? Say I'm the bank, I provided you loan at a 10%. Now you repaid me the loan when the current market rate is 5%. Now I have to invest my funds at 5%, right? So this is a reinvestment risk, that is investment at a lower rate. Okay. So next is the pass-through securities. We discussed the MBS. Okay. MBS, right? If bank collects funds here, that is EMIs, bank collects EMIs and transfers as it is after slicing the commission minus, that is take 10%, reduce 1% as commission and transfer 9% to this investor. Or if there are say 1,000 investors, then every investor is getting the same risk, same return. Same risk as in same prepayment risk, same default risk, and then same return of 9%. In this particular case, this is known as the pass-through security. That is, whatever is bank is receiving, that is passed through the channels and investors are receiving that. Then there are other type of securities where you have different type of structural payments, right? So different types, say these investors will face low risk and they will get obviously lower returns, say 7%. And these investors will receive or get high risk of prepayment, high risk of default. If the default happens, these investors will first absorb that default, okay, and not these investors. The low risk investors won't face the default immediately, okay, because these are facing high risk. They will generally take more interest rate. So from same pool, now you have different categories or type of securities. If this happens, then you don't call it pass through. We have different names here. Okay, so we will discuss that. And in FRM Part 2, you have complete discussion on this. So again, here I will limit my discussion. So there is this particular structuring of this particular pool is called as tranching. Okay, so different tranches are there: senior, mezzanine, equity, and so on, right? So equity tranche faces the highest risk. This is like the same equity in the bank or equity in any company. Equity faces the highest risk, right? So pass-through securities, again, you can read it by yourself. Now, next, when the investor is investing in this particular pool, remember, bank don't have one particular like type of loan or just one characteristic of loan. Okay, there are different loans. Bank provided loan in complete 1 year and there were different interest rates. Bank provided loan for say A, this is for 3 years, this is for 5 years, and this is for 2 years. Now this investor needs to know what is the average maturity or weighted average maturity of the pool, right? Once these receivables are transferred to the pool, this is the part of one particular structure. So investor needs to know what is the average maturity. Investor needs to know what is the average interest rate, weighted average interest rate charged. Okay, so this is called as the weighted average coupon, the WAC and WAM. Okay, weighted average coupon as in interest rate only. Okay, so this is very easy to calculate. Here we will take the example WAC. So say bank provided, like, consider the pool of 5 lakh, which consists of 2 lakh mortgage at 5% and 3 lakh mortgage at 6%. So bank provided these loans. And now investor wants to know what is my average coupon, okay, weighted average coupon. So this is very simple: 2 lakh divided by 5 lakh multiplied by 5% and 3 lakh divided by 5 lakh multiplied by 6%. You are now smart enough to understand like how to calculate the weighted averages, right? So weights are provided here. These are the weights and these are your coupons. Fine. In similar fashion, we can also find out weighted average maturity. So this is the maturity of the first loan, maturity of the second loan, and weight of the first loan, weight of the second loan. 2 by 5, 3 by 5, and 390 months. Okay, now investor got the right information or the proper information. Okay, after knowing this, that is the pool as the 5.6% of like weighted average coupon. Definitely investor will take the call of investing in the security or valuing or pricing of these MBS securities based on this information. Okay, and there are other key statistics which investor might use for his understanding of the quality of the pool. So total loan outstanding divided by total number of mortgages, which is average loan balance. That is, say one borrower took say 3 lakh worth loan, other two borrowers took say 10,000 loan. So he need to know what is the average of like average loan balance or average loan value. Then pool factors, so current outstanding and original value, how much is remaining in the pool. Okay, and then FICO score of borrowers. Okay, and you have WAC and WAM. The calculation is the same for the FICO score as well. So you will take the FICO score. In India, we have that score. I forgot the name. Okay, so some score is there. Why I'm not able to recall it? That's a big problem. Okay. Credit score, right? So in India, we have credit score. Okay, so that's very dangerous. I got the credit score. we get at least 10 SMS on the credit score on daily basis. Okay. So next, fourth is the loan to value ratio, LTV ratio. LTV is the weighted average of whatever is the loan value here. Okay, loan to value. So principal amount of the loan and asset value of the mortgages. So this is, say you have the asset, that is the house or real estate property worth 1 lakh, and bank is providing loan only for 85,000. So bank will not provide, this is not 85,000. Okay, so bank will only provide 85% of loan. Okay, so compared to the assets value. So this is the same in India. Generally banks provide only 85% or 90% or 95% of the asset value as a loan, right? So same thing can happen in everywhere, and this is the loan to value ratio, LTV ratio. And LTV is very important. If this is very high, if this is high, then there is high risk of default. Okay, high risk of default as in whatever is the default, that will directly impact the investor. That's why LTV is very important. I guess one thing I forgot to mention in this particular question or particular topic, what type of question to expect if GAAP decides to like ask question on this, like loan amortization. Maximum you can expect is what will be the ending balance of in second month. Okay, GAAP is not going to ask you what will be the ending balance in 8th month, because you have to work through all the amortization table and everything. Maximum says second month. The GAAP might ask you what is the EMI or like monthly payment, what will be the principal payment in the first month or the second month, like that. So you need to understand how do we calculate or work with the loan amortization table. You should be good with this. Okay, it is possible, generally not the style of like GAAP, but yeah, GAAP might ask you this question, right? So be prepared for it. And second is the most important topic, highly important topic. Why? GAAP asks question on this in almost every exam. Okay, so the conditional prepayment rate and monthly mortality rate. So what is conditional prepayment rate and the monthly mortality rate? We already discussed for the bank and for the investor in the securitization structure. This conditional prepayment rate, CPR, and SMM, single monthly mortality rate, are very important part, because bank faces a risk of prepayment, right? So this prepayment risk is measured by CPR and SMM. I'll again restructure this statement. So bank and investors faces these risks, prepayment risk, and prepayment risk is measured by conditional prepayment rate and single monthly mortality rate. Based on this CPR and SMM, bank will, or the investor will decide the call on like how to invest and how much to accept as a coupon for that particular pool of security, or bank will decide like how they can transfer the pool and how much they can charge. Okay, so this totally depends on CPR and SMM. And again, the CPR keeps changing. Okay, so that's why there is a word conditional prepayment rate. So conditional prepayment rate is because there is a condition like it depends on the market. If say average pool size, okay, so just consider the average WAC, weighted average coupon, that is the average interest rate which is being charged by the bank based on whatever is in the pool. If that is say 6% and current market rate or the interest rate is say 9%. So what do you think? Do you think like prepayment will be higher or lower? Obviously there will be, the prepayments will be lower, because now borrowers know if they prepay and if they have to take the loan, they have to borrow at a higher rate. So that's why they will avoid it. Now imagine a second scenario and say current interest rate is 3%. So obviously borrowers will be more inclined to prepay, right? So that's why this prepayment rate, this CPR is called as a conditional prepayment rate, because it depends on the market condition. So that's why CPR. Second is the single monthly mortality rate. CPR is the annual rate. And again, we know like we are working on the monthly basis. When the mortgage is there, everything is on the monthly basis, right? So because everything is on the monthly basis, we have to convert this into single monthly mortality rate. That is a monthly rate. SMM. Okay. CPR and SMM. These rates can be assumed based on general criteria. These rates can be calculated using this simulation. These rates can be based on the historical factors. Okay, so everything is possible. It depends upon like what type of criteria are used by the bank, and there are also standardizations for these rates. Okay, prepayment rates. So again, this topic starts with the the theory part, which you can read. Now we will discuss this part. How to convert CPR into SMM and how to convert SMM into CPR. So we have formula here. Formula is CPR is equal to 1 minus bracket 1 minus SMM to the power 12. Why 12? Because it's for the 12 month. Okay. So first part is not for the CPR to SMM. First part is SMM to CPR, and this second part is CPR to SMM. Okay. We will use this formula. If you have CPR of say 12%, then we will use this particular formula to convert it into SMM. And if you have SMM, then we will use this particular formula to convert it into CPR, conditional prepayment rate, right? So again, you have to remember these formulas. Again, there is no sense in, or this is very basic formula. Okay, nothing can be explained in the formula as such. So only the thing which I can explain is the reason for 12 because 12 months. As simple as that. Okay. The next concept here is we will see the illustrations. Okay. Here we have I have lot of illustrations for you. Don't worry about it. We will cover every possible type of question from this particular topic, right? So PSA benchmarking for prepayment. So there is thing called PSA benchmarking. PSA benchmarking is, what is the benchmark? Yeah. So this is general name if you want to remember. Okay. So PSA prepayment benchmark is the Public Securities Association standard prepayment rate or the model. So there is a model which decides the PSA rate. Okay. So PSA works in very different manner. Please focus here. So PSA is the annualized prepayment rate. Annualized prepayment rate, and this works in a certain manner. I will just show you where is a PSA value. Okay, just leave. Yeah, we have here. Okay, so PSA 100 and PSA 50 and PSA 150. So what is the meaning of all this? If your CPR is say 10%, okay, when the PSA is 150, PSA keeps on changing. Okay, so based on the pool structure or the market benchmark and everything, so PSA will be decided 150, 100 or 50. If the PSA is 150 and your CPR for this particular current period, okay, so for the next month, remember, even if it is for the next month, you are saying CPR means this is annual. So if it is for say next month, it is 10%. And current PSA, that is a benchmark, is at 150. This means your actual CPR is 10% multiplied by 1.5, which is 15%. And your complete calculation will go at this rate, 15%. If your PSA is 100, then your CPR works like this, 10% multiplied by 1, and your CPR is 10%. And if your PSA is 50, then CPR is equal to 10% multiplied by 0.5, and your CPR, actual CPR is 5% only. So your estimate, that is CPR, multiplied by whatever is the prepayment benchmark going on for that particular time period, right? So based on that, you will use the CPR. Now there is general assumption in this PSA. So general assumption is, so annualized prepayment rate starts from the 0.2, okay, 0.2%, Under the standard model, that is a PSA model, PSA standard model, 100% PSA, it then rises to 0.2 or by 0.2 in every month. I will just show you how it works. These are the months. Month 1, month 2, M2, M3, and so on. And then we have M4 like this. Starts from the T0. Okay. And then we can take Tn, right? Now I have a very simple question for you. What do you think, like what is the possibility of prepayment by a borrower if he borrowed just today or just 1 month back? Probability is very less. Borrowers don't pay, or people don't repay their loan immediately after taking the loan. Okay, so just say borrowed their loan. Again, this is applicable for the mortgages and not for the other parts, not for the like credit card and everything. So this is the borrower. Borrower is took the loan or for the mortgage, borrowed in this month. Immediately next month he is not going to repay, right? But if you imagine after 10 years, if his loan is say for 20 years, and after 10 years, the probability keeps on increasing, right? So this PSA benchmark says that annualized rate of CPR for the first month is only 0.2%. This keeps on increasing by 0.2, meaning 0.4 here, 0.6 here, 0.8 here, and so on. It keeps on increasing like this. And after certain time period, it will be fixed at 6%. So your CPR will be fixed at 6%. This is the standardized model. And it reaches 6% in month 30. And after month 30, the percent stays same at 6%. So this is the information you need to remember at 100 PSA. The standard model says this. But when you are going for the exam, then you have to use like whatever is the base, you have to calculate or use the information, whatever is given in the exam. If it is 150 PSA, we already discussed 150 PSA means it is this 0.2% multiplied by 1.5. This will be 3%, right? Not 3%, 0.3%, right? So this 0.3% will be applicable here, right? So this is how 150 PSA works and so on. And then this will be 9% in the month 30, and then it will be constant after 9th month, right? 30th month. Okay. So let's start with the calculations. I hope you got the idea why PSA is important and why CPR is important. What is the purpose of CPR? It will help you in calculating the prepayment rate. If you know the prepayment rate, then you can better estimate your pool. And based on that, the investors can better estimate the quality of the assets, right? So first is CPR to SMM. Assume the CPR rate of 8% for a mortgage pool. Calculate the single monthly mortality rate. So SMM is equal to 1 minus 0.08. This. And then here we are using CPR to SMM. So to the power 1 by 12. Right? And the result is 0.7%. Second, SMM to CPR. SMM is equal to 0.2% for the mortgage pool. Calculate the conditional prepayment rate. So CPR is equal to, you know the formula, 1 minus your SMM rate to the power 12, and you will get 2.37%. This is easy to understand, right? So I'm not going to spend a lot of time here. Then we have CPR SMM with PSA. Assume the CPR for mortgage pool for a specified month or specific month is 3%. So current month, whatever is the current month, is 3%. Calculate the SMM in given case. So you have to calculate SMM, and again for 50 PSA, 100 PSA and 150 PSA. 50 PSA, 0.5 multiplied by 3, 1.5%. And now you know, you are expert of calculating CPR to SMM. Just apply the formula and get the answer. If it is for the 100, then 3% multiplied by 3, it is equal to 3. SMM is equal to whatever is the answer. Okay. This is actually homework for you. That's why answers are not mentioned. You have to calculate this. And then for 150 PSA, so 1.5 multiplied by 3%, 4.5%, and then SMM. So whatever is the SMM, that particular value will be paid or prepaid in that particular month. Okay. Now this is the PSA question only. PSA question, assume 150 PSA prepayment speed for the mortgage pool. Calculate the CPR and SMM in month 10. Now here you have to first, okay, so you can do two things here. You can multiply this by 1.5 and then work out your question, or simply start with the 0.2. Remember, for the first month, your conditional prepayment rate is 0.20%, 0.2%, right? This is 0.2%. Obviously, at the end of 10 months, this will be 2%, right? 0.2% multiplied by 10, 2%. So in the 10th month, CPR is equal to 2%. CPR at 150 PSA, 2% multiplied by 1.5 is the 3%. Now, if you do this, like first multiply 1.5 here, and if you do the calculation of by multiplying 10, then you will get 3%. Okay, so calculation or the result is the same here. You don't have to bother about it. And now SMM. SMM is equal to 1 minus 0.03 to the power 12. Whatever is the answer is your SMM rate, single monthly mortality rate. Next is the very important question, is estimating prepayment using the SMM CPR. Now imagine you are provided with the, or assume you are provided with the SMM of 0.35% in 10th month for a mortgage pool, and the principal outstanding balance at the beginning of the 10th month is 1 lakh, and scheduled principal payment for this month is $100. Remember, this particular pool has $1 lakh worth remaining principal in the 10th month, and principal payment will be less in the beginning, right? Because in the end, the interest will be lower and principal will be higher. But currently, principal payment is less only. So at the beginning of month, whatever is the payment, say principal left, by the end of the month, this will be principal minus, let's say, EMI's portion of principal. EMIP means, I'm just saying EMIP stands for EMI's principal payment or the portion. And this will be the closing balance, right? Based on this, you have to calculate now your prepayment. So prepayment, the formula for the prepayment is SMM multiplied by outstanding at the start of the month, this minus scheduled principal payment, not the complete installments payment, only principal's payment, which is $100 in our case, and then multiplied with the SMM. So you will get prepayment. Okay, so prepayment is equal to 0.0035, 1 lakh minus 100, and this is your prepayment. Okay, so this is a very important question. So why do we need to first adjust for the scheduled principal? Because it is very obvious, right? Anyway, that principal will be received by the end of the month, right? So first adjust for that, and prepayment is whatever is above that scheduled prepayment, right? Or scheduled principal payment. So that's why we have to first adjust for the principal from the outstanding, and then only you can calculate the prepayment. Okay. Then you have modeling prepayment risk, a theoretical discussion. Okay. So first, generally 4 reasons for the prepayments. Refinancing, right? Turnover, refinancing as in that particular like property, real estate property is again refinanced because the market rates were lower and so on. Okay, turnover is borrower sells his house. Then there is curtailment. Okay, so curtailment arises when the loans are old and balances are low. Generally, by say you borrowed for 10 years and this is the 8th year and principal payment is very less, and you're like, who will hold for this headache of paying every monthly installment? Okay, so generally you will pay it early. So that's a curtailment. And then there is a default. Okay, now how default is prepayment? So default and prepayment is same for the investor. Why? When there is a default, this particular house will be sold, right? That mortgage, because it is a mortgage, you have collateral, right? So when the borrower defaults, that house will be sold, bank will collect the money, and then bank will pay or prepay that particular fund, which is the principal portion of it, in that particular pool, and remaining bank will obviously transfer it to borrower, right? So that's how the prepayment is, like default is also prepayment. You have to remember this. Default is also reason for the prepayment. Okay, so there are 4 reasons: refinance, turnover, curtailment, and what? Default. Okay. Now agency MBS. We'll go back to our discussion. This is borrower. This is bank. This is SPV, special purpose vehicle or pool, and you have investor here. Okay, so this is the general model. So in USA, what happened? US government or Fed wanted to promote the housing developments in their country. Okay, they wanted to make sure that every person owns the house in similar fashion. Like in India, we have the similar type of thing going on, but definitely not in this particular manner. Okay, so as per the US government, the best way to promote house for everyone, that particular scheme, is provide loans or make loans easier. And if you want, or as a government, if you want your banks to provide loans to the borrowers, those who want to borrow the loans, remember this agency MBS is applicable only for like USA. Okay, if that particular government wants this to happen, then there is only one way. This is what the government thought, that is to provide the security to this particular SPV or the investor that we will protect you in case of default. This agency as in these government agencies, will provide this particular security or guarantee type of thing in case of default by the borrower or like that. And obviously, when there is guarantee provided for the default, investor will be more interested in going for this. If the investors are more interested in going for this particular structure, the securitization or buying the securities or the MBS, then automatically bank will get more funds to provide the loans, and then bank will provide more loans, and then again bank will create a next pool, and again investors will buy the securities, and then again bank will provide the next loan, and so on. This is not happening on the individual basis. And for example, I'm saying on the individual basis, this is applicable for say thousands. So in this month, bank provided loan to say 10,000 people, and there are 2,000 investors who invested in the particular pool, and then for the next month, bank will again do this, and bank will keep repeating this again and again and again, right? So this will ensure that bank have enough funds so that bank can provide loans to these particular borrowers. And again, this is applicable for the mortgage only. So this particular government, the Fed, created 3 agencies or supported 3 agencies. So first is the GNMA, FNMA, and FHLMC. Okay, so full form is Government National Mortgage Association, also known as Ginnie Mae. Second is Federal National Mortgage Association, also known as Freddie Mac. Federal Home Loan Mortgage, Freddie Mae. Okay, and then sorry, this is like something Fannie Mae and Freddie Mac. Sorry, this is Fannie Mae and Freddie Mac. Freddie Mac. Okay, Ginnie Mae, Fannie Mae, and Freddie Mac. This is again the abbreviation or kind of a short form for this like long names. Again, this is not my names. This is provided by, or this is used by the Fed or the like US markets and everything. Okay, so these are 3 associations. What do you need to know about these associations? First, these are supported by the government. Okay, this is GNMA is the government agency. Ginnie Mae is government agency. FNMA, Fannie Mae and Freddie Mac, both are private companies, but supported by government. Okay, and this government support is implied and not explicit. That is, there is no written guarantee, but this is implied because the purpose of creating these agencies was to promote the housing in USA. So obviously government will, in case of any big crisis for these agencies, government will support them. This is implied. Everyone knows or assumes this, that if they are going for these agencies, or the securities or the MBS promoted by these agencies, then they have certain type of security from the government, right? Okay, so how this particular structure works? So these agencies will charge some kind of guarantee fees from the investor. In return, they will provide the default guarantee, which is the biggest risk for the these investors. And these agencies will create a pool. Again, this SPV will be from that particular bank only, or maybe there is a consortium of banks. There are 10 banks. They are creating one particular pool. But again, this particular pool will be promoted by GNMA, FNMA, or FHLMC. Okay, these agencies. And if this is promoted by the agencies, then there are different rules applicable, and then we call them as a agency MBS. Agency MBS. Agency MBS means GNMA, FNMA, FHLMC promoted MBS. Okay. Rest of the structure works in the same manner, but this particular, like these particular agencies are the like sponsor type of thing, okay, or guarantors. These agencies provide the guarantee. They also help in structuring everything. Okay, so bank will work with the like pool, nature of pool and everything. That job is for the bank, not for these agencies. Only work of the agency is helping getting the investors and everything, and then providing guarantee to the investors, right? And for what? For the guarantee fees. Okay. Okay. So MBS, normal MBS, agency MBS is this. So agency MBS currently in US market, the major MBS market is agency MBS market, and not the normal MBS or the private MBS market. Private MBS is, there is also like institutions doing everything privately without any guarantee. Okay, so that's a private MBS or the MBS per se. Okay, general MBS. And here we have agency MBS, meaning government promoted or sponsored MBS, like this. Okay, now we have very important discussion, which is the trading pass-through and TBA. Borrower A, B, C. Bank. Agency, okay, government agency. Special purpose vehicle. This is the pool. And these are the investors. Okay. Now see here, we have borrowers. Obviously, now you understand the borrower, bank, pool, and investor structure. Now we have agencies. Okay. So when the agencies are involved, things are on some level, like agency wants some kind of assurance or certainty about the things going well, right? Now imagine a scenario. This bank creates a pool, that is SPV, transfers asset of say 100 million, transfers asset worth $100 million in this particular pool. And then obviously, like to sell security you need pool, and from this pool bank will create securities, and these securities will be sold to the investor. Bank made arrangement, and bank can provide coupon of 7%, or this SPV. Okay, so coupon can be provided at the 7%, and there are no investors available who are willing to invest in these securities at say 7%. I'm just taking the hypothetical scenario, and this is not very correct scenario, but just assume for now. Okay, so there are not enough investors. Now whole exercise of bank got wasted. How? Because bank created SPV, transfers all the assets, okay, and then there are investors, and that's the problem. Okay, there are no investors, that's the problem. Now bank will ask, okay, so first we want investors, and then only we will go for the securitization process. Now the investor will ask, okay, fine, we will invest, but where is the pool? In what structure we are investing? Where we are investing? What is the contract? Remember that security is the contract. On what? What is the underlying here? So bank is saying, no, we will create some pool. Okay, so now the problem for the investor is, okay, they are, even if they are willing to invest, there is no pool. Okay, so to handle this particular situation, this remember this TBA is only applicable for agency MBS, and if you consider agency MBS, 90% are TBA only. I will explain what is a TBA. So this TBA, to be announced, is the structure or the security which works like a forward contract. So bank will say, okay, right now we don't have any asset in our pool, we will transfer it, but first we need certain type of assurance from the investor that whatever we are going to work with this pool, whatever we are doing with the pool, that has certain type of guarantee or the assurance, that is there are enough investors. So bank will first issue TBA, and TBA is called to be announced. So bank will first issue TBA to the investor, and these are very short-term TBAs, okay, securities. So for 2 months, 3 months, generally, whatever time bank need to create a pool and everything. This TBA won't mention the structure of the pool, like the WAC, WAM, or LTV, loan to value ratio. All this information is not provided. The exact structure, the composition of the pool is not provided. Bank will provide, okay, this is general criteria, the like approx structure we are going to plan or we are planning to create, okay, and you have to invest in this, and this is the percentage or the coupon rate. The investor will invest in TBA first and say this is the start of the TBA, T0, and this is the T1, and investor will purchase TBA here, and at the end of this time period T1, this will get converted into the actual MBS. Okay, so bank will transfer the pool, bank will create the pool, and then, like, say this is the date of transfer of the security, bank will provide the information about that pool just 2 days before. Okay, 2 days before that, all the information will be reviewed. Remember, investor will know about the approximate idea, they will have the approximate idea of all these properties but not the specifics. Second, investor will know about the duration of MBS, or the maturity of the MBS, coupon and everything. All this basic information which any investor is like wants to know about their security, that information will be provided. It is just like, imagine you have like call option, you just don't know the underlying, like that. So you know the call's maturity, you know the call's premium, you know the type of call, it is an exotic call or the plain vanilla call, like that. Only problem is you are not aware of the what is in the underlying. That underlying will be declared just 2 days before your options exercise price. So this is how the TBA works, right? And if bank, which is applicable in the non-agency MBS, if bank first creates the pool and then provides the securities, this is called as a pre-specified pool. So these securities MBS are from the pre-specified pool. Okay, pre-specified, and then second is the TBA, to be announced. Okay, and there is problem with the TBA because so TBA seller is the bank or the particular SPV. Okay, SPV is the TBA seller, and just like the bond structure, TBA seller have that particular option, like to deliver the cheapest to deliver thing. Okay, just remember this. This particular point is kind of important for your exam. Now the most important and confusing point for the students, which is a dollar roll. Okay, so what is the dollar roll and how it works? We will discuss this. Okay. Now here we have TBA. First TBA, which is maturing in Jan. Second TBA is maturing in like Feb. And just take the example, this is 5th of Jan, 15th of Jan and 15th of Feb. So these are two different TBAs but similar TBAs. Like all the properties are similar. Obviously, that particular pool of asset will be different because these are from the different TBAs, right? The different pools, different originators and everything. Even if there are same originator, obviously asset won't be the same because this TBA is issued from a different pool. This TBA is issued from the different pool. But basic characteristics are same for both the TBAs, both the TBS pools. This particular TBA structure can be used for borrowing funds. How? So, you know the repo, repurchase agreement. So what happens in the repo? So this is T0, this is T1, and this is borrower, and this is lender. Okay. At T0, this borrower will sell securities. Okay, will sell securities to this particular lender, and this lender will pay for this, say $100. Okay, and at time T1, there is a borrower and lender. Now they are reversing the transaction, right? The repo is borrow and like reversal of that borrow, right? But in the form of securities or the sale or purchase. This borrower will purchase his securities, but he will pay 101. That is something extra on the purchase price. If he purchased for 100, if he sold, the borrower sold for 100 and took the $100. Now at the time of reversal of the transaction, this borrower will transfer 101, that is he will buy back or repurchase the securities, and remember the same securities at slightly higher price. So this difference of $100 and $101, 100 minus 101, this $1 is the cost of borrowing or kind of interest rate. So why this borrower is paying slightly extra for this repurchase at the time of squaring of this transaction? Because he borrowed the funds, right? So this is repo transaction. Repo transaction works in the form of purchase or sale of the collateral or the security. Okay. Now TBA is the same. TBA seller will sell near month security, TBAs, and then he will purchase the next month's or that next to next month's securities, TBA. So effectively his position is like squared off kind of thing, not exactly squared off, but it is settled, plus and minus type of thing. Okay, but the difference is he will always go for, or there is no as such like the higher price or lower price for the TBA. There is no intentional price charging. Okay, so because TBA is like there is a fixed price, right? So for this purpose, this particular algorithm, or not algorithm, like particular structure works in a manner that it will automatically create a cost for this particular borrower. So he will sell, just imagine 1 lakh worth of TBAs is sold here. Now this particular TBA seller have 1 lakh. He will use this 1 lakh till this particular point, and then he will buy TBA. So he will pay 1 lakh. Okay, and he will get the TBA. And in between, we will see what is the cost for this particular borrower or the TBA seller. TBA seller. Remember, TBA seller is doing this activity of selling TBA in the near month and buying TBA in the latter month for borrowing of funds. This is the easy way or the cheaper way to borrow funds. One. this particular, like whatever is the cost incurred by him is called as the dollar roll. Dollar roll. So dollar roll is the cost incurred by the TBA seller for borrowing funds. In exam, if you get what is the borrowing cost for this particular TBA seller, you have to simply go for whatever is the dollar roll versus the value which is sold. Okay, value of TBA which is sold. So let's see with the example. This is similar to the GARP's example. Okay, so for example, trader could sell USD 50 million 30-year FNMA pool. Why are we mentioning agency here? So because remember dollar roll, TBA, and okay, so TBA is applicable for the agency MBS, and dollar roll is only and only applicable for TBAs. Okay, so that's why we have to like the specific mention of this FNMA agency. Okay, he sells the USD 50 million 30-year FNMA pool with 4.5% coupon for Jan settlement. And then again, he will buy USD 50 million 30-year FNMA pool at 4.5% coupon for the Feb settlement. Why the coupon is same here? Remember, just like in repo transaction, the securities should be same. Okay, so whatever the borrower is selling first and then buying it back again, the securities should be same. Here, the TBA's basic structure should be same. Underlying can be different. Okay. Again, the same thing is mentioned here. The dollar roll is same as repo rate and repo and everything. Okay, so everything is mentioned. And again, you can read this. Okay, so we will directly jump to the actual discussion. Here, the key point here is the security purchase may not be the same. We already discussed. And no interest is added to the price at which the securities are repurchased. Again, the same thing. Okay. So this is a difference between the TBA and repo. Okay, so if GAP asks you the question, like what is the difference between the repo and TBA, you can use this. Then defining terms. So this is what we need for the calculation of the dollar roll. First is the price at which the pool is sold. This A stands for price at which the pool is sold for the first month. B stands for the price at which the pool is purchased during the second month. C stands for the interest earned. Remember, if you sell and get 1 million, that 1 million will be, you might invest it somewhere, but here we will assume like this is at the risk-free rate or the whatever is the RF. So you will earn interest on it for say 1 month. If you are doing this TB or the dollar roll for 1 month, then you will earn the interest for 1 month only. So this is the interest earned. Interest earned on whatever you sold. D is the coupon and principal repayment that would have been received on the pool sold during the first month. If you don't sell this particular TBA, then you will receive principal and interest, because remember, this TBA acts like the MBS. The only thing is at the time of maturity, TBA will get converted into the actual MBS, and at that time you will know whatever is in the pool. But coupon principal payment will be same, okay, for TBA and the MBS. So obviously by selling it like this, you will lose on principal and the coupons, right? So the dollar roll is calculated as A minus B plus C minus D. Okay, we will see the illustration. For example, suppose that USD 1 million par value of 4.5% pool sold for USD. This is the USD 102.50 in the March and repurchased for USD 102.00 in April. We suppose that the payment date is the 12th of the month for both the months, and this means that the accrued interest of USD 1500. How this 1500 is calculated? Remember, 4.5% is general interest rate assumed. 12 days of accrual, right? Divided by 30. So 12 divided by 30. Then your interest rate divided by 12, 4.5% divided by 12, that is 0.045 divided by 12. And then this is the interest rate which will be accrued on the MBS or the TBAs. And this is based on the whatever is the proportion, okay, the value of your MBS selling. And same will be applicable for this particular as well, right? So this B, because again the same principles are applicable here. That is also maturing in the the settlement date is in the 12th, right? So for both the settlement is the 12th, so there will be 12 days accrual. Fine. Now the question, I hope you got this particular part, like how this accrual interest rate is calculated. Now let's see how this particular part is calculated. That is the A's, that is the value of the security, that is total sale value of this particular TBA, and that is total purchase value of the security TBA. So what you have to do is, see here, this is 102.5 of notional value. So how to proceed with the calculation? Your total value is 1 million. Okay, this is 1 million multiplied by 1.0250 for this. Remember, for 100 par, price is 102.50. So for 1 million par, price is 1.0250, and plus accrued interest, which is 1500. If you perform this calculation, you will get the first value. Second value is, this particular value is 1 million multiplied by what is the price of repurchase, 102. So 1.02, and then plus accrued interest. You have accrued interest here, right? Okay. Now assume that the proceeds of the sale in the first month can be invested at 0.1% for a month. Okay, so 0.1% is assumed as a monthly investment. So remember, this 0.1% is on the sale proceeds and not on the 1 million. Obviously, whatever you will sell, you will invest it for the 1 month, right? So this 0.1% multiplied by 1026500. So you will get this value C. And then in calculating D, we assume that if the pool had been sold, interest and principal payment, and this is the interest and principal, this is a 0.45%. So coupon rate for the TBA is 4.45%. So here you have 4,500 as a D. So this is what you are losing because of the sale of the TBA. So now let's summarize this calculation. At this price, assume yourself, you sold the TBA. At this price, you are buying the TBA. Sell, buy, right? So what is the difference? Is the profit for you. And remember, the price is always after adding accrued interest. This is what you earned on this particular sale because you sold it for 1 month. So whatever funds you had, you invested it. So this is again your income, interest earned. And this 4,500 is what you lost because of this sale. Lost because of sale. That 0.45%, right? 0.45% on 1 million. This is what you lost because of the sale. For that 1 month, you don't have TBA, right? So this is the total cost. Okay. So this is how dollar roll works. So you have to remember this. Fine. So here the value is positive. Okay. Now remember, dollar roll can work in both the manners. So it totally depends upon how this particular dollar roll is structured, how the pricing is working for the dollar roll, and so on, right? And dollar roll in this particular case is used for earning the income, right? So just do this calculation and you have 1,526. So this is the earning. Now imagine if the situation is slightly different, like here you have like coupon, the loss of coupon is very high, then you will lose on it. Fine. Okay. Now other agency based MBS, CMO. CMOs are the securities structured using pass-through securities in which the cash flows are distributed according to the category of the security. Remember I told you like there can be tranching. So if the tranching is done, the different category of securities are created, then we call it as a CMO. Then we have PAC, plan amortization class. So their amortization will be different. Okay. So is a type of CMO. So PAC provides a prepayment risk protection with the help of support tranche, which is packed with the PAC. Okay, at the issue. So there will be CMO and then it will be with the PAC. And if the prepayment rate is faster than the set limit, the support tranche will absorb the excess prepayment. Good if you understand this in FRM Part 2. Okay, right now this is discussed in very summarized manner. It is difficult to understand it here. Then you have principal only securities and interest only securities. So we discussed, right? So in pass through, complete principal and interest is transferred to the investor. So that particular pool or SPV can create two types of securities, principal only and interest only. So some investors will receive their income or the return or the coupon based on the principal payments, and others can receive on the interest only category. Okay, so that your EMI will be split into two parts. So principal only securities, and what happens in PO securities. You remember we discussed the amortization table where the interest payment or the principal payment is small in the beginning and increases in the end, and interest is high in the beginning and lower in the end. So this PO investors receives proportion of the principal proportion from the mortgage. Cash flow streams are low. This is the key point you need to remember for the exam purpose. So cash flow streams are low in the beginning and gradually increases with the time. Okay, and these are extremely sensitive to the prepayment rate because these are the principal securities, right? Second, interest only securities. If the prepayment happens, obviously the principal only security will bear, principal only strip investor will bear all that prepayment risk, right? Then there is an interest only strip. Interest only strip is IO strip. So IO receives interest portion from the mortgage pool, and IO security cash flow starts big and gets smaller with the time. Hence, IO have shorter effective life than PO. Okay. Then there is valuation of MBS pool. This is completely theoretical discussion, like how you can use the Monte Carlo simulation and everything. Then there is an option adjusted spread. Again, more in part 2, FRM part 2. Right now, for option adjusted spread, OAS, you have to only remember the OAS, the spread is difference between the expected MBS return, whatever is the return on the MBS for the investor, minus return on the treasury instruments. Okay, like this. Fine. Again, this is highlighted for you in case you want to read it, but not testable area. And there is a lot of content written here. You can ignore this particular part. Just remember what is the option adjusted spread for this basic information. And this is the process actually. Okay, so how the OAS can be calculated and like that. Again, not the part of FRM part 1's like proper curriculum. In FRM part 2, we have very detailed discussion on this particular part, right? So this is all about the MBS securities. See you in the next video. Thank you everyone. Thank you for watching.